Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to the latest installment of our 2024 Second Half Outlook podcast mini-series. In this podcast, we explore a topic crucial for investors starting their financial journey: the allure of high-income assets versus the potential benefits of a balanced portfolio. It's common for investors to favor income-generating assets like bonds and dividend stocks for their steady cash flow. But is this approach always optimum for long-term growth? In the ensuing discussion, we shall discuss why immediate cash flow isn't always synonymous with long-term wealth accumulation. Here to discuss with me on this and more is Audrey Goh, Head of Asset Allocation. Welcome, Audrey. As you might be aware, many investors have an income bias when it comes to investing, preferring assets portfolios which pays a high income versus one which does not. Why might a high income strategy not be the best approach for long-term growth, and how can a balanced portfolio help?
Well, thanks, John. So a high-income strategy often focuses on generating immediate cash flows, either through bonds or dividend-yielding equities or a combination of both. While this is beneficial for people who have retired or those seeking income and stability, it may not always be optimal for long-term growth because without substantial growth, high-income strategies can in fact struggle to keep pace with inflation and also to maintain their purchasing power. So a balanced portfolio, on the other hand, it has some bonds, but also includes a good amount of growth assets like stocks, which may not pay much of a dividends, but do have the potential to significantly increase in value, and that's quite key. So this combination allows investors to benefit both from immediate income to some degree and also long-term capital appreciation, leading to overall better returns and wealth accumulation over time.
What are the key differences between income portfolio and balanced portfolio in terms of maybe performance and also the risk?
Well, income portfolios are typically quite heavy in bonds and dividend-yielding stocks, which provides the allocation, the portfolio with a steady cash flow and stability. They are generally quite popular among those needing income. However, in terms of performance, they often lag behind balanced portfolio in terms of total returns because they lack substantial growth assets. A balanced stock bond portfolio with a slightly higher allocation to equities than bonds typically outperformed income portfolios from a total returns perspective. In fact, if we look at historical data since 2009, it showed that a balanced stock bond portfolio outperformed a pure income portfolio by almost twice as much, which highlights the importance of including growth assets into the investment mix in order to better capitalize on market upswings and compound wealth over time. And this assumes that the investors also reinvest the distributions received from the income portfolio.
Since you touch on that, how does not reinvesting income from dividends and interest, how does that impact the long-term growth of an investment portfolio?
Well, if one does not reinvest the income, whether is it coming from dividends or interest, it can in fact significantly diminish a portfolio's long-term growth potential. While income portfolio provides regular cash flows, withdrawing this on a regular basis instead of reinvesting them means missing out on potential powerful effects of compounding. And over a long period of time, this can lead to subpar returns as the portfolio's growth potential is being hampered. So for long-term wealth accumulation, it is imperative to reinvest the income to capitalize on compound growth and enhance the portfolio's overall performance.
Okay, so focusing on not just on the income, but reinvesting of the income to enhance investment total returns. Can you also explain sort of the significance of total returns and how it affects both investment performance and also retirement planning?
So total return encompasses of interest, dividends, and capital gains, right? So this measure is one important measure of financial success. However, for many investors, if we were to just focus solely on income, it can be quite misleading because it does not account for potential losses in asset value. So evaluating performance on a total return basis basically provides ones with a more holistic view of portfolio performance, considering both income and growth. And this is crucial not only for assessing investment success, but also for retirement planning. As investors approach retirement, understanding total returns and how they can affect their withdrawal strategy becomes essential for preserving as well as distributing wealth sustainably.
Oh, that makes sense. I'd like to just move on to another topic, right? So many people have talked about the 4% rule for retirement planning. What is this 4% rule and why is it important for sustainable withdrawal during retirement?
So the 4% rule is a time-tested principle which suggests that investors can withdraw 4% of their portfolio in the first year of retirement and then subsequently adjust for the amount with inflation every subsequent year. And this 4% rule basically aims to ensure that one do not deplete their funds, say over a typical maybe 30-year retirement period. So higher withdrawal rates, for example, such as 8% or even 6%, may provide one with more immediate comfort, but certainly do increase the risk of running out of money prematurely, especially during market downturns or during periods of high inflation. Moreover, the higher the rate of withdrawal, that will also limit the portfolio's growth potential, given that a large proportion of the assets is being used for current expense and withdrawn out, and then less is being left to invest and compound over time. And this can be quite detrimental during the early years, given that the effects of compounding are most potent over long term. So keeping to the 4% rule is key to balance immediate income needs together with the portfolio's growth potential, thereby promoting long-term financial sustainability.
Well, we are running out of time here. Thank you so much, Audrey, for breaking down the importance of crafting a diversified portfolio. We hope this podcast is useful for you. If it is, please do not forget to like and subscribe to the SC Money Insight channel. Lastly, thank you for listening and do remember to come back tomorrow for the last installment of the podcast mini-series. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.